Hey everyone, and welcome. Today, we're going to crack open a powerful asset class that, honestly, a lot of investors just seem to forget about. But it could be a total game changer for your long term growth and stability. We're talking about real estate investment trusts, or, REITs. But before we dive in, I've got a question for you, and I want you to really think about it. Take a good, hard look at your current investment strategy. Is it actually built to last? Are you really confident it can handle all the crazy ups and downs the market loves to throw at us? It's a tough question, but it's one you've got to ask. Yeah, because let's be honest, trying to build wealth these days can feel like you're walking through a minefield. There are so many challenges that can keep you up at night. It's what we call the modern investor's dilemma. I mean, you see the headlines, right? You've got that wild market volatility that makes your account balance look like a roller coaster. Then there's the constant search for some kind of reliable income, which is tough when interest rates are all over the place. And on top of all that, you have the silent killer, inflation, just eating away at the value of your money. Each one of these is a huge headache. It feels like you're fighting a war on three different fronts, doesn't it? But what if you weren't? What if I told you there was a single tool, just one, that could help you fight back against all three of those problems at the same time? Well, the answer might just be hiding in plain sight, in an area that we all know but often feels, well, completely out of reach for most of us: real estate. But hang on, we're not talking about saving up a huge down payment to buy a duplex. Let me introduce you to the Real Estate Investment Trust, or REIT for short. Simply put, a REIT is just a company that owns or finances properties that make money. Think about it: the apartment buildings we live in, the offices we work in, the malls we shop at. When you invest in a REIT, you're basically becoming a part owner of a whole portfolio of these places. Okay, here's the best way to think about it. Imagine owning a tiny slice of a giant real estate empire. You get to collect your share of all the rent checks that come in every month, but you never, ever have to get a 2 a.m. phone call about a leaky faucet or a broken toilet. It's all the perks of being a landlord with literally none of the headaches. Zero. So how does this all work? How can REITs be so powerful? Well, to really get it, we need to break it down into their 5 key superpowers, really. We'll call them the 5 pillars that make REITs such a fantastic potential addition to your portfolio. All right, pillar number 1, diversification. You know the old saying, right? Don't put all your eggs in one basket. Well, real estate often dances to its own beat. It doesn't always move in the same direction as the stock market. So when stocks are having a bad day or a bad month, real estate can actually hold its ground or even go up, which acts as a fantastic cushion for your overall wealth. And that's exactly why you hear experts call REITs an underutilized tool. They really can help you weather those market storms. By adding something to your mix that zigs when everything else zags, you're just building a stronger, more resilient portfolio. Simple as that. So how much are we talking about here? What's the sweet spot? Well, a lot of financial advisors suggest that an allocation of somewhere between 5 and 15% of your portfolio to REITs is a pretty good target. That's enough to get the real benefits of diversification without going too overboard. Okay, let's talk about the second pillar, and this is a big one for a lot of people: income. If you're someone who wants your investments to generate a steady stream of cash, this is where REITs just, well, they really start to shine. And this all comes down to one magic number: 90%. You see, by law, this is a legal requirement. REITs have to pay out at least 90% of their taxable income to their shareholders, and they do that through dividends. That rule is what turns them into these absolute income-generating machines. So what does that actually mean for your wallet? It means that whether you're living off your investments in retirement or you're just trying to build up some passive income on the side, that rule creates an incredibly reliable stream of cash. It's a level of consistency that's pretty hard to find anywhere else. Pillar number 3, it's all about making things easy, like really easy. If you've ever even thought about buying a physical investment property, you know the drill: massive down payment, tons of paperwork, and it takes forever. Well, REITs just blow that whole model up because they trade on stock exchanges just like any other company. You can buy or sell shares with a few clicks. It's that simple. Okay, pillar 4 is a big one, especially right now. It's a hedge against inflation. Think about it. When the cost of everything else goes up, what also tends to go up? Rents and property values. And since REITs own those exact properties and collect those rents, their income goes up right along with inflation. And guess what? That extra income gets passed along to you as a shareholder, helping your money keep its buying power. And for our 5th and final pillar, we've got a 2-for-1 deal. First, you get professional management. Every single REIT is run by a team of experts whose entire job is to pick the right properties and manage them well. you don't lift a finger. And second, you often get some nice tax advantages because REITs themselves don't pay corporate taxes, which can mean more money ends up back in your pocket. So when you step back and look at the whole picture, what you've got here is a way to get all the great benefits of investing in real estate, but without any of the classic headaches that come with it. Let's just put it side by side. I mean, just look at this. The difference is night and day, right? With traditional real estate, your cash is locked up for years, the cost to get in is huge, and you're the one dealing with all the problems. With REITs, it's the complete opposite. You can get your money out whenever you want, you can start with the price of a single share, and it's totally hands-off. Okay, but let's be real for a second. No investment is perfect, right? There's no magic bullet. So it's super important we talk about the risks, because REITs definitely have them, and you need to know what they are. You've basically got two main things to keep an eye on: interest rates and the economy. Since REITs often borrow money to buy new properties, when interest rates go up, their costs go up too, and that can squeeze profits. And of course, if we hit a big recession, some tenants might struggle to pay rent, which hurts income. The good news is you can manage these risks by spreading your money across different kinds of REITs, like ones that focus on apartments or healthcare facilities or warehouses. So what's the bottom line here? The big takeaway isn't just about one of these pillars. It's about how they all work together. Adding REITs to your mix is about making your entire portfolio more resilient, better at generating income, and better positioned for solid growth over the long haul. And that really leaves us with one final question. And this one's for you. Now that you see how this tool works, how accessible it is, and the problems it can solve, it's time to ask yourself, what role could real estate play in your financial future?